Good evening, everyone. Thanks, Nuwan, for that introduction. In terms of the format of the call or the presentation today, there are five different sections. Uh, we'll have a presentation for about 40 minutes, and then we'll have a Q&A for about 15 to 20 minutes. So I hope to cover a little bit of a basic about unit trusts and how the structure works, and what are different types of unit trusts you can have access to, uh, and and what are the fees involved, and what are the benefits that either a small investor or a medium scale investor could attain by using unit trust as a medium to access equities. And then we'll discuss a little bit about equities and how equities have performed in the local market context over the long run, how they performed in terms of returns. And we'll also discuss about why someone should look at equity in the current context, whether this is a good time to invest in equities. And we'll also discuss a little bit about systematic investment plans, which is not an area that is widely discussed, but it's very important, especially for youngsters who are just starting their working career. And finally, we'll close off the presentation with a little bit of discussion on some of the best practices that you can adopt when you invest in the equity markets through a unit trust. So let's get started. So in terms of an introduction to unit trust, very simply put, a unit trust is a pooled investment plan. So investments are pooled from various investors, be it small investors or medium-scaled investors, in exchange for what we call a unit. And as unit trust managers, the funds that we receive are used to buy securities on behalf of the unit holders. The investments that are pooled are basically combined into a legally formed trust. And this money that is then the money that we basically receive gets invested according to the stated objective of the fund that you invest into. So there are multiple types of investment unit trust funds that we can discuss about in detail as we go along. Generally, there's equity and fixed income type investments, and the pooled money is basically invested by the fund manager into these asset classes. So this slide kind of shows you how unit trust investments work from a flow perspective. So as the investor, you bring in cash. Just like you, there are multiple other investors. So the fund is created with the money that is pooled in. And there comes the trustee. So the trustee, you can think of the trustee as a large bank, generally, that safeguards your assets. And then the fund manager takes control of the funds that are invested. And in turn, they would invest according to the stated objective of the fund that you invest in. If it's an equity fund, we would invest in equities. If it's fixed income oriented funds, depending on the objective of the fund, we would invest in various instruments. And in return, if it's an equity fund, you would benefit from capital appreciation. If it's a share price moving higher, or you might get dividends. If it's a fixed income fund, you would earn interest on the funds that we invest. And in return, these funds are sent back to the investor, not necessarily through a cash flow. Usually it happens when the fund's value itself increases, reflecting the increase in interest rates as interest income as well as dividend income or the appreciation of the stock. Sometimes some funds opt to give dividends, but that is not mandatory. We will discuss a little bit more about it as we go along. And SEC, the Securities and Exchange Commission, also plays a key role as this entire structure is regulated by to kind of provide some distinction between management companies and the trustee. The management company or the asset manager itself are responsible or is responsible to manage your funds. So they take the call on where the funds are invested, on what securities. If it's an equity fund, on what sectors or on what specific shares the money gets invested. So that investment decision is taken by the management company, and the management company needs to have a net minimum capital of 25 million rupees. Whereas the trustee, which I mentioned earlier, is usually a large bank. They are like the gatekeepers to your funds. So at any given point in time, the fund is always under the care of the trustee. And as investment managers, we provide instructions for the trustee to execute a transfer. For example, if you want to buy a particular fixed income security, then the fund is always with the trustee. We give them instructions for the trustee to send the money out and receive the securities. And the trustee also ensures that the funds are managed in accordance with the regulations that are put in place by the Securities and Exchange Commission, what's mentioned in the key investor information document, which is an important piece of document for each fund. And all the rules are basically adhered to. In terms of benefits that you would accrue when you invest through a unit trust, it doesn't necessarily have to be equity fund, but in general, you would have instant liquidity, especially with a money market fund. If you were to put some money in with a day's notice, you would be able to take the money out. So there is liquidity when you invest through a unit trust. And then you are able to take the role of a large scale investment despite having large investments. So basically, majority of the unit trust funds allow you to invest with just a minimum capital of 1,000 rupees. Not all of them, but most of them allow you to invest or start investing with 1,000 rupees. But you are able to get the benefit of opportunities that would come across for larger investors because the money is pooled in. You're able to get that advantage despite contributing a small amount of capital. And these investments are managed by professional fund managers who are looking at the markets daily and have deep understanding and experience in the market. So you're only contributing the capital. You're not necessarily putting in the work in terms of benefiting from the returns. You are getting the expertise of a professional fund manager. And in terms of administration, it's become a lot more convenient through a mail without even visiting the premises of a unit trust manager. You can easily create new investments or redeem money by the way of emails now. And in terms of choices as well, depending on your own investment objectives, whether you're investing money to kind of build wealth over the long run for retirement, or whether your objective is to build for something that's more near term, but there are various funds that you can take advantage of, which we'll discuss a little bit as we go along. And these are, as I mentioned when we were running through the flow, these investments are very well regulated and they come under the purview of the Securities and Exchange Commission. In terms of the drawbacks, as opposed to investing on your own, you do not have much of a say with the investment decision. You don't necessarily have a say on where exactly the money that you contribute gets invested. And as with any investment, returns are not guaranteed or assured, uh, especially in the case of an equity unit trust. It's very much dependent on market conditions. In an event like, let's say, in 2022, when the market had a relatively tough year, it's very unlikely that a unit trust can provide you a positive return when the market itself is down 30%. Obviously, the unit trust can provide you a better performance by limiting the losses. It might have a slightly much lesser loss of capital or maybe a drawdown compared to the market by active stock selection, but you would be exposed to the market movements. And finally, in terms of management fee and other fees related to unit trust, that's something that you need to keep an eye on when you invest in a unit trust. You need to go through the key invest information document and understand the fees involved and ensure that you do not pay a fee that is at a premium to the rest of the market. And in terms of the classification, so there are mainly three different types of unit trust funds based on the underlying asset classes. So you can invest in debt funds. These could be money market funds, gilt-edged funds, and income funds. Money market funds normally would not allow any investments that are beyond 12 months. So those are short-term liquid funds. A gilt-edged fund would be funds that would only invest in government securities, and income funds would be funds that would have a bit more longer term horizon on fixed income. Whereas with equity funds, you can break them into growth fund, index funds, and sector funds. Normally, an index fund is a fund that tracks the performance of the index. There is no active selection of stocks. With regards to sector funds, it would only focus on stocks in a particular sector. For example, if it's a banking sector stocks, it would only invest in banking shares. And then a balanced fund is a mix of both. Here, you try to take advantage of basically asset allocation. If you, based on your view of the macro, based on your view of the interest rates, you would switch between equity and debt in terms of the allocations. In terms of a return and risk graph or return and risk trade-off, with debt, as you can see, usually the gilt-edged fund is the safest option. But normally in any type of investments, the lesser risk you take, risk in terms of volatility of returns, not necessarily losing money or anything like that. But in terms of volatility of returns, the less risk you take, the return tends to be low. So gilt-edged is the safest instrument, especially it's backed as it is backed by the government. And then you have money market funds, which are short-term funds. You have gilt-edged and income funds. As the risk increases, you get higher returns. And the same goes for equity side of things as well. An index fund which directly tracks the performance of an index would probably rank lower in terms of risk as well as the returns that you might get. Whereas a growth fund, which would look at investing in growth-oriented companies, would normally have a slightly higher volatility of returns, but that is compensated with better returns in the long run. And in terms of NAV is a very important concept with regards to unit trust funds. So that's the net asset value. To put it very simply, how this is calculated is somewhat important because this is the basic measure through which you can understand the performance metrics of a unit trust company. So NAV is basically all the assets that is carried on the books of a unit trust minus the liabilities. Liabilities in terms of any fees, be it management fee or any other accrued expenses, and that gets divided by the number of units that are there in the fund. That would give you the NAV. So in terms of the returns itself, when you invest in a unit trust, let's assume that it is a balanced fund which has exposure to both equities and fixed income, you will have shares on your book, you will have bonds on your book. So depending on the market valuation, the movement of the NAV would also differ. If the equity valuations are moving higher and interest rates are coming down as bond values move higher, you will see that re-rating happening in the NAV as well. And in addition to this, when you invest in equities, you'll get dividends. When you invest in bonds, you get coupon payments. So these all add up to the NAVs or the asset book value of the fund. And this in turn will reflect in the NAV, which is basically the value at which you trade in and out of the fund. And with regards to this NAV, these are marked on a daily basis. So valuation is done on a daily basis and it's approved by the trustee and it's published to the market. And just to also give you a bit of understanding of how the price itself moves or the NAV itself moves, when it's a money market fund, you would see a steady upward trend. The volatility is much less. The downside risk is much less, given that you're necessarily investing in short-term fixed income instruments like T-bills and other instruments that are less than 12 months. So you will see an upward sloping curve as what you can see on the left side of your chart. However, the returns can be lower in a period similar to what we're experiencing right now, where the interest rates are much lower and in a more stable environment. But if you go back 2 years back, the rates were more than 20% given the economic crisis. And during such a time, you can make a significantly higher return. In the case of equities, as you can see on the chart or the graph to your right, you will see a lot more volatility. The price can go up and down, but if you see over the long run, the trend is upwards. And there are reasons why equity prices go up over the long run, which we will discuss a bit more when we go into that section. And in terms of returns, I briefly touched on this. From an investor's perspective, you make returns through capital appreciation that comes from investing in equities and bonds. And this in turn will reflect in the unit trust price or the NAV itself going up, where you can book the profit by selling your unit trust units. In terms of income distribution, some funds provide a dividend payout proportional to your investment. And that's not a mandatory thing. Not every fund gives you a dividend. But if in the case that your fund doesn't provide you a dividend, you have the option of partially selling out your trust to get that cash flow, unit trust. And also, let's quickly discuss about some of the things that you might have to pay attention when you decide on a unit trust and when you're doing your market research to choose which unit trust to invest into. You need to compare fees that are charged by different unit trust companies. There could be management fees, there could be front-end fees and exit fees. These are fees that you would pay at the point of entering a unit trust as well as redeeming your money from a unit trust. So you need to see if the fees are fair. And you might also want to see the fund size, the size of the asset under management. A larger fund would mean that as a small or medium-sized investor, you would have less friction in terms of entering the fund or exiting the fund. And you would definitely have to pay attention to track record. When I say track record, it's not about the last 6-month performance or the last 12-month performance. You need to look at the track record over a couple of business cycle, I would say, over like at least 3 to 5 years, so that you know how the fund has done during a period when the market's gone through a bit of a recession or a slowdown, how the fund has done, how the volatility has been. And it's also important to not just purely look at returns, but you need to also look at how much these returns vary from month-to-month perspective so that you're comfortable with that level of volatility. And Also, when you evaluate a performance, like I mentioned, it's important that you look at the consistency of performance as well. And expenses, like I mentioned in a unit trust, there are certain expenses which are deducted as liabilities when we arrive at the NAV, and there are certain expenses which are not deducted, but they are directly attributable to the investor itself. So in the case of expenses that are deducted at arriving at the NAV, these could be the management fee, the fee that is paid to the trustee for safeguarding your assets. Every 6 months, an audit is run. So there are audit fees involved, and there are fees that are paid to if there's a dividend payment, there are certain expenses that come about. So all these are basically factored into the NAV. So when you arrive at the NAV, it's already deducted as accrued expenses. But there are some other fees, for example, the entry fee and exit fee. Not every fund does this, but certain funds have an entry fee, which is a fee that's paid by the unit holder at the point of entering into a fund. And in an event where you exit your position within a year, this is not applicable mainly to money market funds, but rather on equity funds. Certain funds may have an exit fee, which basically charges you percentage if you were to exit your position within a year or within 2 years. So it's very important to read through the key investor information document of that particular fund to understand the fees involved. And finally, to give up, I mean, if you want to delve deeper and understand this space a bit more, there are a couple of links that I provided. There is a Unit Trust Association website where you can find a lot more information about how these unit trusts work. And there's also an Excel sheet that's published on a monthly basis, which tracks the performance of all the funds, regardless of the type of funds, regardless of the management companies. The fund performance is tracked over the last 5 years. So you can go there and see for yourself in terms of the performance of various funds, and you can take a decision based on that. And also, all the unit trust companies, at least majority of them, try to communicate quite a bit in terms of their fund performance and what they hold in their respective funds through monthly newsletters, fact sheets, etc. These could be obtained by visiting the websites of these management companies. So through that also you can learn more about unit trust investing. And these are some excerpts from some of the publications that we put out as a part of CLSA funds. So we have an equity fund, we have a money market fund. You could see that we put out a newsletter every month, which details out a lot of information, gives you a perspective of what the fund manager is thinking, where most of the money is invested in. Is it in equities or is it in fixed income assets, a balanced fund? You could also see the performance over a 3-year basis. You can look at how volatile the fund has been, and you can also look at the top 5 holdings in the fund. You know, what specific investments do we hold? So that level of information is provided, not across the board, but you can get this information. And we also put out a fund manager review on a 6-month, 12-month basis, which you can pay attention to. And in terms of the local unit trust market, there are 16 management companies that are authorized to operate unit trusts. The names are listed down here. You can visit each of the company's websites also to get more information about the funds that they manage. The minimum investment is 1,000 rupees, regardless of the funds that you invest in, but it's not mandatory. So there could be certain management companies and funds which may have a higher minimum fee. But in the case of CLSA funds, these are the lowest investment is 1,000 rupees. So you can start with just 1,000 rupees. And in terms of regulations, there are certain regulations that are put in place by the SEC. So SEC is the ultimate authority in terms of giving, granting licenses or suspending license to unit trust management companies. So they also do the work of a watchdog as someone who safeguards your investments. And SEC also approves all the contents that we put out in terms of promotional material, in terms of the communication of performance. So when you see a performance communication, you can be sure that it is already verified by the SEC. And with unit trust, there's also a limit to have at least 50 unit holders in any fund that you operate. And there are also investment specific or fund specific restrictions such as liquidity and how much of the money should be in liquid form so that the fund can easily honor any redemption requests, and there are certain maximum exposure limits as well. And that basically kind of gives you a understanding of the unit trust industry and the structure of the industry and how it works. And now I would like to maybe discuss a bit more about equity unit trusts, and given that that's where the focus is today. And I would like to first start by talking a little bit about equities and how equities have done in the local context, and how it has been a good avenue to build long-term wealth. So in this chart, you can see the performance of investable asset classes in Sri Lanka. We've looked at the post-war period, and you could see that equities has been the best performing asset. Despite all the volatility we've seen, despite all the crisis that the country has gone through and the setbacks we've seen, equities have provided an annual return of 16%, and it's the best performing asset. And this in comparison to the more popular forms of investment, such as 5-year T-bonds and the fixed deposits. If you look at the 5-year T-bonds, that has provided an annual return of about 12.6%, and the 5-year and the average weighted fixed deposit rate is roughly around 12.5% during this post-war period. And we also need to be mindful of what's happened with the USD, given that Sri Lanka is a net importer. The rupee has weakened against USD over the long run. So in order to ensure that you maintain your purchasing power, you need to at least ensure that your funds grow at above 6% so that you continue to hold the purchasing power. So the USD has basically strengthened against the rupee by 6% on a yearly basis over the last 16 years. And in terms of the second best performing asset from an investable point of view, it is the gold. It's gold, which has grown at about 14% per annum. And moving on, in terms of equities, as we saw, despite all the volatility, it has been the best performing asset. And in the realm of investments, there's usually a quote which goes as saying that what's perceived as risky in the short run is often the less risky option in ensuring that you not only protect your wealth, but also grow your wealth. And there are reasons why equity has been the best performing as a class. One being, when you buy equities or when you buy stocks, you're essentially taking part ownership in companies. So these are, so that basically means that you're investing into a management which is agile. When the economy goes through a growth phase, the management can take appropriate actions to ensure that the businesses grow in line with the economy. And when the economy goes through a setback or a recession, they can take appropriate actions, and this gets reflected in the performance of the stocks that you hold. And necessarily, when you really look at it, stock performance is a reflection of earnings and growth in earnings of the underlying company. So whenever you think of buying stocks, you need to think of it like buying companies or businesses. And that has been a key factor in equity returns being better than rest of the asset classes. And then equities also provide you protection against inflation, because as price levels increase, the majority of the companies that you would invest into are consumer focused or consumer facing. So they would see their product prices also increasing, which would in turn drive the top line, and that flows into earnings. And in return, the valuation becomes too cheap and it has to catch up. So we see the prices also moving in tandem with inflation. And thirdly, it also provides you a hedge against the LKR itself weakening. As what we've seen over the last 16 years, the LKR has weakened by 6% per annum. So investing in equities gives you that hedge against the currency weakening. You can do this by investing in export-oriented companies. And generally, when the currency weakens, those companies tend to do well. And finally, you would also always get dividends when you invest in dividend-oriented companies. So this in turn also adds up to equity returns. And let's move into why equity in the current context, given the current macroeconomic environment, why one should look at equities. So equities tend to outperform when some of these factors are present. So let's go through them one by one. When the economy itself is either recovering or in an expansion mode, equities tend to do better because that in turn drives top line and earnings, etc. So you see that benefit come through. So we've seen a very strong recovery, which is turning into an expansionary situation in the Sri Lankan economy. Since about the third quarter of last year, we've seen continuous year-over-year growth in the underlying economy, which is very positive for equities. And the second factor is the interest rates being low. So usually when the interest rates are low, it leads to more money in the hands of the people, which could move into new investments. And it would also result in finance cost savings for corporates, which would result in higher earnings, both of which would drive more money into stocks. And thirdly, when interest rates come down, your alternative to stocks in fixed income give you lesser returns. So that in turn also pushes more money into equities, and that we've seen over the last 6 to 12 months. And this chart basically shows you how equity performs against interest rate movement. So as you can see, this graph kind of shows that there's a clear inverse relationship between the performance of equities and the performance of interest rates in the market. So whenever the interest rates is on a declining trend, we see a corresponding increase in the equity index. And right now, with the 12-month T-bill being auctioned around 7.58%, and even the lending rates around 8 to 9%, these are very conducive interest rates for equity markets to thrive. And in terms of inflation, that's also a very important factor. When inflation is moderate, the central bank tends to be pro-growth. The central bank tends to cut interest rates in order to ensure that it stimulates growth, which in turn is positive for equities, as lower interest rates drive asset prices higher. And in the current context, equities are tax-free. So when you invest in equities, any capital gains that you earn when the share prices move higher, they are not taxed. Only on the dividend that you receive, there is a final tax of 15%, which is a WHT. So it's paid at source. You don't have to pay anything extra, which gives a advantage to equities as an asset class as opposed to fixed income instrument. So if we were to look at some of the key benchmarks, you look at the 5-year bond, which is trading around 10.5% at the moment. Your after-tax return, if you fall into the highest tax bracket of 36%, you would be getting a post-tax return of only 6.7%. With a 12-month T-bill, this drops down to 5.3%. And with new fixed deposit rates being at 6.6%, your post-tax return is only at 4.2%. So these are very nominal returns. So this also basically drives more money towards equities. And from the perspective of the central bank as well as the fiscal policy, we are in a very healthy space. The central bank has been on a policy easing cycle since the mid of 2023, and even today they held their rates steady. And from a fiscal point of view, there's been a significantly improved fiscal picture, given that we are a part of the IMF program. We are running at a primary surplus, so there is less pressure on the interest rates. All of this are drivers of the sort of rally that we saw in equities the latter part of last year, and sort of we believe that this would be a continuation moving forward for the rest of this year as well. And moving into the companies itself, as I mentioned earlier briefly, the stock prices are a reflection of earnings growth. The underlying earnings of the companies and how much they grow tend to get reflected in prices in the long run. May not happen immediately, but it will definitely happen in time to come. So what we've seen is from 2023 to 24, we've seen a significant jump in corporate earnings. We've seen a 43% increase. These are driven by a number of factors. The ISP reversals have helped the banking sector, and we've seen with the interest rates coming down, the companies are paying less in terms of finance expenses. So these have all driven the corporate earnings higher, which basically in turn drives the stock prices higher in time. And this also kind of shows that relationship. As you can see in this chart, we have plotted the performance of the index against the index EPSs. And whenever you've seen a spike or an upward momentum in the EPS, except for the 2022 period, basically the index did not reflect the increase in earnings because of the economic crisis. But in general, whenever we've seen a spike in EPS, that has been followed by a pickup in the index as well. Normally, the index tends to move ahead of EPS because it tends to factor in future information. And our view is that we will see another growth year in terms of index EPS for 2025, which in turn will get reflected in stock prices. And from a valuation perspective as well, the index PE itself has shrunk a little bit when compared to maybe 5 years ago, given all the economic crisis and the instability that we witnessed. But now with stability returning and the economy is on a growth path, we believe that the fair multiple for the index itself has more room for upward re-rating, which is another factor that would drive a valuation side. And compared to the region as well, the Sri Lankan equity market is reasonably valued, especially when you look at other frontier markets. And from a ROV, the return generating capability and dividends that are obtained, you could say that the equity market is in a good space in terms of valuation, and there is further scope for upward valuation movements. Moving into the fourth part, which is a bit more relevant, as now we've seen that equity has been a very strong long-term asset generating class, as well as from a wealth building perspective. We'll discuss a little bit about systematic investment plans and how, as a early investor or someone who's looking at unit trust investing, could benefit from this. So there are two ways in which you can access equity markets. You can either have your own CDS accounts and trade on your own, or you could invest through an equity unit trust. So when you invest on your own and when you self-manage a portfolio, there are a few things that you need to be mindful of. It's very important that you spend a bit of time and you're able to do your own research into stocks that you buy. At least read a few research reports from various sell-side research brokers, and get an understanding of any stock that you buy. For this, you will have to spend a bit of time. And thereafter, once you make an investment, it's also very important. Maybe you don't have to check it every day, but at least once every 2 weeks or once a month, you need to be able to sit down and be able to go through your portfolio and see how the funds are performing. And as a direct equity investor, you should also have the risk appetite to see through volatilities, because the stocks don't always go up. Even good stocks can come down and stay down for a while. So you need to really know your risk appetite well, and you should not be someone who would buy into the hype and sell into weakness. You need to have that mindset to buy good companies and hold them when economic conditions are not favorable. So these are some key characteristics that you're going to have. And the advantage of investing directly is that there is a possibility that you could even outpace the performance of a unit trust. But you need to ensure that your stock selection is on point and it's very good, which takes a lot of experience, and it also takes a lot of effort as an investor. The problem with this is that when you directly invest, you might invest only in a few names, so it could result in a significant amount of volatility in returns, and it could also result in capital loss if you're not experienced or if you don't buy the right names. If you buy into hype, there could be a situation where you overpay for a stock, which could result in either permanent capital loss or an underperforming investment over the near term. So if you're someone who do not have the time, if you're not in the field, if you're not a finance, if you don't have a finance background, and unfortunately you don't have the time to follow the markets, then unit trust investing is a better option for you to access equity markets and still benefit from the return potential. As we saw, equities have done exceptionally well, and equity unit trusts have also benefited from that. So if you're someone who's like thinking long term, and if you want to build some money for the long run, then you can choose equity unit trust as an option. The benefit of doing this is that you do not have to spend as much time as you would otherwise have to if you were to invest on your own. And your money is taken care of by a professional fund manager who's looking at the market daily and making investment decisions on your behalf. And this also means that there's much less time and effort that you would have to put in terms of fundamentally analyzing a stock. The benefit of this is that in frontier markets like ours, even with an equity unit trust investment, you could significantly outperform the market, as we would see in some of the subsequent slides. The issue is that it is not tailor-made, it is not specific for you, so it might not sometimes align with the return and the risk objective that you specifically have. But the advantage is that for less effort, your money gets managed by a professional fund manager and you get very good returns. Let's take CLSA Equity Fund as an example to run through some numbers in terms of how investing in equity unit trusts, equities through unit trusts, would have benefited an investor from a longer term horizon. So let's assume that someone invested an initial lump sum. In this case, we assume that someone invested 1.5 million 3 years ago. So 2022 was just coming out of a crisis. If someone had invested 1.5 million at that time, over a 3-year period, with an investment in the Comtrust or CLSA Equity Fund, they would have roughly 2.5 million, so which is a return of about 18.5%. This in comparison to assuming that there is an index that directly tracks the performance of ASPI, they would have 2.2 million. There is no index as such. But if there were to be an index that directly tracks the performance of ASPI, that would have given you 2.2 million and a return of 12.5%. If you had invested this money in a 1-year FD on an average FD rate and rolled it over for 3 years, you would have gotten 2.1 million, and that's a 12.9%. So, a 3-year horizon, clearly investment in an active equity unit trust has benefited the investor with much less effort. Take the 5-year horizon, you would have made that 1.5 million into 4.2, which is an annualized return of 23, almost 23%, which is a very strong return. A similar performance by the index itself would have given you 24%, and a fixed income alternative would have given you only 11.2% and a return of 2.5 million. So over a 3-year and a 5-year horizon, if you were to invest an initial lump sum, you would have significantly done better with the equity unit trust. And instead of investing a lump sum, what would have happened if you were to get into a systematic investment plan? A systematic investment plan is a situation where you put a certain amount of money on a monthly or a 3-month basis, on a quarterly basis, and you would stay invested on a consistent basis. The advantage of doing this as opposed to investing a lump sum amount at one point is that you're not taking the risk of timing the market. You're investing when the market is going higher, you are investing when the market is coming down, so you get a good average over a longer period of time. So it gives you the benefit of what they call cost averaging or dollar cost averaging. So which is also a better alternative for younger investors who are just starting out, as they are able to start off with small investments. You can even do this with thousands. But when you invest over a period of time, you grow your, you create significant wealth by being exposed to equities. So over a 5-year horizon, if you had invested a lump sum amount of 1.5 million, that would have turned into 4.2 million at an annualized return of 23%. And if you had done the same thing by over the last 5 years, if you had invested 25,000 each month, it would also would have resulted in actual contribution of 1.5 million from your end, and you would have had 2.9 million by the end of it. You would have almost doubled your contribution, and that works out to about 25% annual as you invest money over a period of time. This is even more visible over a 10-year horizon, because over a 10-year horizon, the market has gone through a lot of volatility, a lot of up years and down years. There have been a few years that where the market had struggled. So as a SIP investor, you would have gained even more, and that's clearly visible in the numbers. So if you had invested a lump sum amount of 3 million, that would have turned into 7.5 million roughly at an annualized return of 9.6%. However, if you had gotten into a 10-year SIP and invested 25,000 rupees every month, you would have contributed the same 3 million, but you would have gotten an even higher amount than investing the entire amount at the beginning, because you got the benefit of investing into a weak period in the market. So the important thing is to be consistent, not be overly perturbed by the market fluctuation, but to remain consistent throughout your investing period until your goal is met. And let me just conclude the presentation with some best practices that you can adopt when you invest through equity unit trusts. The first thing is, it's important if you're an early investor who has a very long runway. Let's say that you're just starting out your working career, and majority of the people at least work 30 years. So if you're someone who has that long runway, or even if you're older, you could think of this as a saving for your children, or you could always open a joint account and save for your children's higher education. Or if you're very old, you can think about your grandchildren as well. You can always get into a systematic investment plan. The good thing with systematic investment plans is that you do not need large capital. As I mentioned, CLSA Equity Fund accepts 1,000 rupees minimum investment. So you can start with a small investment amount, and you can build that portfolio over time. Because it's quite evident from the charts that we saw earlier on that equity has been the best performing asset class. So if your requirement is not near term, it makes more sense to have money into an asset class that's going to give you the highest return despite the volatility in the near term. So you need to look at equities and equity unit trust as systematic investment plan, and you should not think of it like a get rich quick scheme. It's not about putting some money into a unit trust fund and doubling that money in a year and then losing half of it the year after. You should always look at the more longer term picture when you invest in equities. And then secondly, like I mentioned, don't bite more than what you can chew. So it's important that you decide on the amount that you want to invest on a monthly basis. It has to be an amount that you can that you can manage with your income and expenses, the amount that you can save on a consistent basis. Because if you invest too much, if you invest more than what you can chew, what happens is in the event that the market goes through a correction phase, or if the market goes through, let's say that the economy goes through a slight recession, in such situation, obviously equity is going to have a very volatile period where you could see a drawdown. So if you invest more than what you can actually invest, you can lose motivation, and you could lose you can lose sight of the long run benefit of investing. So if you invest a small amount that you can manage on a monthly basis, then you can build that nest egg over a period of time. And obviously, there will be good periods over a 4-year cycle. Normally, at least 1 to 2 years, you would see a very strong equity market. So during that time, if you have any requirements, if you have to take some money out of the fund, you can do that. In case of requirements. And when you invest small amounts, in the case of even an emergency, you wouldn't dip into the equity funds. You would rather dip into a money market fund or something else. And then it's also very important to, when you invest into an equity unit trust, it's also very important to evaluate fund performance at least every 3 to 5 years. Because whatever I mentioned, you could be looking at the longer term and investing for your retirement, or you could be looking at investing over 30 years. What you don't want is to look back 30 years down the line and get to know that your fund actually grew at only 7% or 8% at a much lower rate than what you were expecting. So it's important that you evaluate the performance of the fund every 3 to 5 years. As I mentioned, we put out newsletters every month. You could get a lot of information from management companies. So it's important to at least evaluate the performance every 3 to 5 years. And also, it's important to avoid short-termism. Do not look at just year-to-date returns or 12-month returns, because that creates a lot of noise. So it's good to have a look at the near-term returns, but don't take decisions based on near-term returns. Take decisions based on 3 to 5 years sort of horizon, and see if you're able to at least meet your return objective of 12% or 15% on an annual basis. And it's very important to be patient, and it's very important to have a very disciplined approach, so that you can take the advantage of the cyclicality of markets. And in the case of especially frontier markets like Sri Lanka, there's a lot of sentiment involved, and the valuation tends to overshoot and undershoot. So as an investor, you can benefit out of that. So as long as you stay patient and get into a systematic investment plan and contribute the same amount of money every month, you can easily set up a direct debit from your bank to get that started. It can help you significantly. And before we complete, I just want to run through a couple of key concepts. So it's very important as an equity investor to understand the concept of compounding. So what I put here is the formula for compounding, which is basically the amount that you put in today, which is the present value, into 1 plus the return at which it grows into the number of years you stay invested. What a lot of investors tend to focus is the amount that you put in and the rate at which it's growing in the short run. Although the rate is very important, and the amount you invest is also important, what's more important is how long you stay invested. I would illustrate this as we go along. So it's very important that you focus on staying disciplined and putting, even if it's a small amount, it's very important to continuously stay invested. And that's where an equity SIP can come into play. So this would allow you that you're not really relying on timing the market, but rather just you're basically spending time in the market and allowing the compounding to help you out. So we'll take a few examples. So if you are someone who's investing 25,000 rupees, so it's an example, on a monthly basis, and you're looking at generating 15% an annum, and you invest over a 5-year horizon, you would actually invest about 1.5 million during the course of those 5 years. And at the end of the 5 year, you would have 2.2 million. So you have some return. Let's say that you do the same thing over 10-year horizons, and you continue to maintain a 15% annum per annum return. You would actually contribute 3 million, but you can see that your money is doubling to more than 6.8 million by the end of 10 years. If you continue doing this for 20 years, then you actually contribute about 6 million rupees, but the balance on your account will be 37, as long as that 15% annual return is maintained. So it's almost becoming 5 times. And if you continue this for 30 years, you actually end up contributing only 9 million rupees, but you end up with 173 million rupees. So that's the sort of power that compounding possesses. So you need to stay invested. usually you start seeing massive returns beyond 10 years. So if you're someone young, it's not about the amount of money that you invest. It's about staying invested on the long run and being consistent with the new inflows that you bring. And finally, I would also like to discuss about the magic of number 72. So, as I mentioned, it's very important to avoid short-termism when you invest in equities, because you're really investing for the long run. You're investing for your retirement, or you're investing for, let's say, a down payment on your house, or you're investing for a down payment in your car. So you need to have lifestyle goals like that when you invest in equities. So anything that is more shorter term, let's say that you want to save up for a holiday, you want to save up for something else that is more shorter term and doesn't require that much capital, you can do that with a money market fund. You can do that with a fixed income fund. But if you're looking at lifetime goals, then that's where equity can really help, because that's where the multiplier effect happens. So with the rule of 72, it helps you to assess how quickly you can double your money. So it's not necessarily about making 30% in a stock or making 50% on a stock in a year. It's more about being able to consistently double your. So you can use this simple formula of 72 divided by roughly the percentage of return you're making on investments to figure out how quickly you can double your money. To kind of give you an example, if you are able to grow your money at 15% per annum, you double your 72 divided by 15 would be 4.8. So you double your money every 4.8 years. So over a 48-year period, you can technically do 10 doubles. That means 10 to the power of 10. You can technically do 1024 times your initial investment. So in one lifetime, someone can basically 1000x the initial money that they put in. So for example, if someone puts 25,000 rupees today and stay invested over 40 years, continues to grow at 15%, that 25,000 alone can turn into almost 25 million. Not a lot of people do this, but sometimes it's as simple as that. So it's not about the amount of money you invest, it's about being disciplined. And before we close off, I'll just run through a few slides on the equity fund that we manage and some information there. So this fund has an AUM of about 358 million. It has grown at a CAGR, or it has grown at an annualized rate of 20.2% over the last 3 years, which is a significant outperformance over the index, which has grown at 12.5%. And we also provide quite a bit of information in terms of shorter term returns as well. So we provide information on the longer term return, which is more important, but also we provide information on the short term returns and how the fund has performed in relation to the market and how volatile it's been. We also communicate monthly performance, which we feel is important, especially for someone who doesn't want large volatility or large drawdowns on their investments. So this is something that we publish on our monthly newsletter, where you can see on a monthly basis how the fund has performed. And finally, we also show like a graph which shows that how the fund has performed in relation to SBI over the last 5 years, and we've generally outperformed the market. To find out more information about our funds in particular, you can visit any of these links. You can write to our email ID, which is shown on the screen, and you can also reach out to our business development executive, whose information is shared here. So I hope with that, I sort of conclude my presentation. I ran about 5 minutes extra, but in general, I hope this gave you all an idea about building long-term wealth and how equity and equity unit trust can play a major part and role in this. And you're able to do all of this without dedicating a significant amount of time. All you have to do is like ensure that you have a direct debit set up so that the money flows through the equity unit trust. And maybe every 3 to 5 years, evaluate performance very critically. And if you're not making the desired return, then look at alternative options. You can look at performance of other management companies and look at how their funds are doing, and you can take those calls. But in general, this is a very important aspect when building long-term returns and long-term investments. And with that, I'll conclude my presentation, and I would be happy to take any questions if there are any questions. Thanks.